Thank you everybody for coming. So today we're talking about survivability and DeFi for the next cycle. So we're about 5 years into the lifespan of DeFi. I guess since, if you count DeFi summer as the beginning of DeFi in 2020. It's quite a bit more mature right now than it was back then. So yeah, we're just gonna discuss what's it gonna take to survive. But first, let's do a quick, brief round of introductions. So if you want to start, Sap.
Yeah, thanks for having me. My name's Callan. I go by Sap online. I'm the co-founder and CPO of Threshold Labs. And we're the team that's basically taking control of the growth and development functions for Threshold Network. Threshold Network is a decentralized network that facilitates Bitcoin capital flows in and out of DeFi via an asset called TBTC. And we're live on all of the major platforms and on Ethereum and beyond. Have about 700 mil in TVL in Bitcoin terms. We've been operating since 2020, and we're excited to be working in the Bitcoin DeFi space and building the Bitcoin economy.
Hello everyone, my name is Marco. I apologize for the voice. We have been having a little bit too much fun, I think, at Token over the past 2-3 days. ZKSync is one of the large layer 2 technology provider that are working to scale Ethereum. We were the first to launch a ZK rollup almost 5 years ago. We were the first to launch ZKVM like a couple of years ago. And we are currently working to really scale the adoption of blockchain. In particular, we are very focused on DeFi, on consumer, and on enterprise adoption.
Hello, my name is Pauline. I am the developer relation at Wormhole Foundation. So Wormhole is the leading interoperability platform in the space. We basically connect to more than 40 chains. And today we have our main client today are the institution. So you have, for instance, big fund issuers like BlackRock or Apollo and so on. They will go through Securitize, and then they would be able to transfer all the assets on chain via Wormhole, which is literally one of the best DeFi use case, TradFi DeFi use case at the moment. So yeah, that's pretty much.
Hello, my name is Joshua Medix. I'm CPO of COTI Network. We're the fastest, lightest privacy layer for Web3. We use a technique called garbled circuits, which allows for fast, efficient, cheap, compliant privacy. We are an Ethereum layer 2, fully EVM compatible, and we really focus in on kind of like 3 verticals, DeFi being one, RWA and tokenization, also working with institutional clients. And mainly what we allow you to do is to have compliant privacy where you can have privacy on chain, but also do reporting to whatever regulators you need to report to on a public network. We offer something called privacy on demand, which allows you to be on a different network, Solana, Sui, Ethereum, Arbitrum, etc., but still gain a new privacy superpower via the COTI network.
Awesome. And I'm Matt. I work with 1inch. We're a DeFi aggregator and swap marketplace. And yeah, so before we can really figure out what it takes to survive the next cycle, we kind of have to figure out where we're at in the cycle right now. We're 500 days into this quote unquote bull market. Where is it going? Who knows? But based off of where you see where the market's at now, how are you preparing things on your side for the next drawdown, I guess, to make sure that everything's robust and that it's going to be sustainable?
Yeah, so in terms of where we're at in the cycle, it's a really good question. I think if we look at historical cycles, we're probably close to the top, but this doesn't feel at all like a historical cycle. Seeing this mainstream adoption or attention from institutions, especially in the Bitcoin space and the DAT companies and these kind of new easy access vehicles to the crypto space that haven't existed before, and the regulatory environment. Yeah, and it's not my strong suit kind of predicting the top of the market, but I think we could be entering into something that we've never seen before, where mainstream adoption starts to change the kind of cyclical nature of crypto that we've seen in the past. So it would be interesting to find out. I think we'll know in the next few months if that's going to be the case or if history will repeat itself.
So I totally agree. I think the typical cycle that we saw in crypto, the plus 10x, minus 90%, it's probably over. There's too much institutional money in the system, which doesn't move as fast as the traditional original crypto degens. And then there is enterprise adoption that you rightly so mentioned. Enterprise move very slowly, but then they're sticky. They don't really shift their strategies once they embark onto something, and they are not going to be moving in and out too fast. And there's maybe something else that we can hope that is happening, and probably it's also already started to happen. Many of enterprises that are choosing to use the technology, it's kind of rational for them to also be slightly invested in that technology. And we know for now, for example, we saw at least some of this happening on Ethereum. And it could be the traditional cycle that Bitcoin goes up very much, and then some of the gains are recycled into Ethereum and then into other alts. But I think it's also that many enterprises that are looking at using the technology are then getting a little bit of exposure to the asset class. And the same may be true for other alts as well.
Yeah, well, yes, of course I agree, because I hold the same opinion with you guys. And I think what is also very important is that with the institution coming, it's maybe good at some point that we don't have this massive dip once it's a bear cycle, and then like a massive up when it's a bull cycle. Like the liquidity comes from different sources. Like the majority of the liquidity now coming from institution just does not allow the price of like random token to vary that much. So I think it's something that we haven't seen before. So now we are like looking at what's gonna happen next, basically. Like with all the mass adoption coming, hopefully sooner than later. But I think it's very hard to copy paste like the previous bull and bear market. So I agree with you guys. It's new. It's a different narrative we're having now, and we see the market is evolving differently.
Yeah, look, COTI is an OG, and I think we stopped caring about cycles. I know that's a sidestep, but I think with all cycles, you have to put your head down and you have to build. I do think that we're entering into maturity in the ecosystem, writ large. So regardless of cycle, I think several things are going to happen. You're going to start to see a lot of M&E. We're already seeing early iterations of that, but I think a lot of smaller projects who aren't going to be able to sustain themselves are going to start getting bought up. You're going to see mergers. You're going to see acquisitions, et cetera, or M&A, excuse me. And the other part is, I think, is exactly what you just said, Pauline, is that we are going to see the first real institutional adoption. We're seeing every major equity firm has already touched tokenized assets in some form or another, and we're going to see that true adoption as regulatory clarity comes, as we have regulatory maturity, and we see bigger firms start to come in. So it's M&A, it's institutional adoption, and I think it's M&A across the board.
That's a really good point, because with the last Terra Luna collapse, we saw a ton of liquidity just exiting the system, and it was kind of it felt like a house of cards. Maybe in a lot of ways it was. So things have grown substantially. So potentially there could be more risk now that things are a lot larger. There's a lot more liquidity in the system than there was back then to start with. So when capital rotates out in a bear market, what mechanisms do you rely on to keep that liquidity in your protocol? Are there any specific features or incentives or things like that that you guys have? Maybe we can start with Josh.
Yeah, so we've just launched a project called earn.coti.io. I think that's on the DeFi side. So this is for people who have been in the COTI ecosystem for a long time. Encourages them to come and earn yield by participating in the ecosystem. That's one aspect, but I don't think that that's something that can fully sustain long term. So it also has to be coupled with kind of the real world yield that comes from real world assets and tokenization. I think as we start to mature as an industry, we'll start to see kind of yields start to parity out with what exists in TradFi. And so I think what will sustain money coming in is having easier access to investments, easier access to capital, and easier access to the assets that people want that actually deliver the type of yield that we've seen in TradFi, but maybe a little bit higher because there's more capital efficiency.
Yeah, like just to build up on top of that, I think also because of the nature of the capital where it's coming from right now, you kind of have very separate user, right? Like you have the DeFi native people, and then you might have the institution, and therefore, what you will have in a previous cycle where like liquidity might completely run out because everybody sold, and they might or might not buy the diff, but like it's not expected to happen, right? Like in the sense that the liquidity that BlackRock is bringing is not going to disappear from one day to another. Like so you actually now dealing with two different audience, and so Wormhole not being a chain, to us it's a completely different game than if we were a protocol like a blockchain, basically. So for us, as long as they are volume transferred, and you could consider that maybe the more the volume, the better it is, the more the liquidity, basically. But like, as long as the volume keep being transferred, there's no reason for us to have a different feature. Like it's and that is because we are an infrastructure. Like that's a bit different. But yeah, like I agree that what you will get with yield-bearing token, for instance, in interoperability is very important. The way you transfer those tokens, like user might want to, they have a yield-bearing token on Ethereum, they want to use it on the Solana DeFi protocol. You need to make sure that your infrastructure allow that, because that is literally why they go from one ecosystem to another. And yeah, so you need to make sure that this liquidity doesn't fly out just with your token, right?
I tend to agree. We take the same exact view that you guys take, and is that, so I think you started to describe what type of users are on chain. Now you have the kind of original, or the people that really are using the chain for some product market fit. I don't know, someone in Argentina, for example, clearly has product market fit. I cannot buy US dollar easily, but if I sit in US dollar, I don't have 22 in the past, 1,000% inflation. This is product market fit, it's great. Liquidity will stay there as long as the peso doesn't perform. Then you have the very highly incentivized, very movable, highly mercenary liquidity. I don't know what's the percentage. It could be 70, it could be 20, I'm not sure. I think this group is probably the most difficult to incentivize. You can do incentive, but it's very, very expensive, and it's very PvP, so it will move very, very fast. And personally, I think that in a down market, incentive don't work with this group of people, so it's probably a waste of money. But it could be a nice sprinkle on top, another strategy, if there's a bull cycle. And then there is enterprises. Enterprises are very slow to come, but they are also very, very sticky, and they have a real user. And if you can give them something with utility, so there is a good reason for them to have the assets on chain, then I think the whole game is origination of distribution partnership that can take your real world asset and sell them to people in the right countries with the right structure such that they benefit from having the asset in that format, and then good assets. So we at ZKSync, at the moment, luckily, we are the second largest RWA marketplace in the world at the moment, just after Ethereum. We have roughly half the AUM that Ethereum has, and we have 3 times more than number 3. And the main reason was that these assets are interesting. We focused on private credit, which has 8 to 12% return and a reasonable probability of default. So the overall net return are positive. We focus on venture capital. We focus on these kind of things that could be quite attractive, and people may want to own them irrespective of the incentive that they get. And I think this will be the nice shift. They will also get more money, more net new money into the system overall.
Yeah, I think we're in this new market, and looking at past cycles, we have much better utility on chain than we've had before. Like there wasn't a hyper liquid live last market, and having something that is driving this organic volume, like it's kind of market agnostic to some extent because there's volatility and there's speculation on the price, and there'll still be trading activity on these venues. So I think having some of these fundamental value drivers that are kind of consumer oriented and doing insane volumes are enabling some of the kind of longer term use cases and yield opportunities in DeFi. And for TBTC and Threshold, for example, like a lot of our users use Bitcoin as collateral to borrow US dollars and do some kind of USD yield strategy. And I think that this larger rotation of capital that we've seen in previous cycles and in other markets and in this cycle as well, like a lot of points farming, a lot of speculation on airdrops and these kind of things, that is the mercenary capital that will come and go. From Threshold's perspective, like we've been in the market for quite some time, since 2020, our token's fully diluted. We do some token incentive stuff, but the amount of emissions that we do versus the amount of capital that we have on our protocol, simply just, we couldn't pay for that amount of TVL without some kind of organic level of yield being generated. And that's how we're seeing the Bitcoin space generally, and the economy that we're trying to build on chain is people actually wanting to use Bitcoin for USD kind of stablecoin yield-bearing stuff, or just simply financing things from their Bitcoin balance. So I hope, and my kind of perception is that we're in a bit of a different market than last time, at least from TBTC's perspective. We're not simply paying people to provide liquidity on our network. People are doing so because there's real volatility that they can make money from, and I hope that that's going to have some stronger stability throughout the next cycle if there is this big drawdown or rotation of capital.
That makes a lot of sense. I mean, as the space gets more mature, capital is probably just less likely to go elsewhere because that's just where the economy is going to be. So, yeah, that makes a lot of sense. So, warning signs. Like within each of your respective protocols, like what are the actual metrics that you're looking at that are indicators of turbulent times ahead, or like what's like that one metric that you don't want to wake up and see and just be like, okay, like this is not good, like this is heading in a direction where like 3 months from now, like we're going to be in a really bad spot. And what sort of like reassurances do you have that you can mitigate that when it happens? Like what sort of like protocols or I should say like systems do you have in place to help mitigate that?
Yeah, I'm happy to start. I think, we'd probably be looking at TVL as probably the primary thing. And if there's an enormous drawdown on TVL, I think, to me, I think people aren't necessarily, at least users of TBTC, they're not rotating in and out of Bitcoin per se. It's whether they're rotating in and out of like on-chain DeFi use cases for Bitcoin, or they're just trying to hold it on mainnet. And I think that comes down to like a balance of the risk perception of the market, of the strategies that they're executing, but also the risk perception of the protocol itself. And I like to think that, having been in the market for 5 years without a security incident, that kind of margin in terms of the protocol risk of Threshold is reasonably low. And then generally the consensus of the world, it seems, is that Bitcoin is a safe asset, so they're not rotating in and out of Bitcoin so much. But if we did see a large drawdown in Bitcoin, it would be an indicator of one of those two things from the protocol. But instead, we're actually seeing this very kind of steady organic growth, and we're at all-time highs in terms of our TVL. And it's not something that we're simply paying people to allocate to our protocol. There's this seemingly organic growth curve if you look at some of our numbers. So hopefully that continues, whether there's like a big kind of exodus from this DeFi kind of altcoin market in a particular bear market, and hopefully there's a new floor in terms of the Bitcoin price generally because of this institutional adoption that will support a stronger Bitcoin economy on chain in the years.
I mean, in our case, for those who don't know, ZKSync is two things at the same time. One is we have ZKSync Era, which is a rollup that we built 2 years ago and has been running for a while. But the other is we generalize the technology to allow anyone to create their own rollup. And this is where I think most of the growth over the next 3 to 5 years will really come from. So the number to take a look at is a net new chain joining the Elastic network, which is what we call the network of chain that are using the same prover, the same ZKSync prover. So warning sign will be that you stop seeing this number growing, and or that you start to see this number even decreasing. So that will be a very big problem for us. But otherwise, the vision is that any very good application will eventually want to become its own layer, its own roll-up. It could be layer 1, layer 2, we'll see. Empirically, we're already seeing this to be true with Hyperliquid, with DYDX, with there's so many examples that are kind of, I think confirming this thesis. And the other is that enterprises will not want to join a big blob like Hyperledger or Corda. Again, we saw this happening in the past, and we saw that kind of consortium don't really work, and they are starting to warm up very much to public chain. One of the key issues is privacy, which I think we have to figure out. But once we figure out privacy, which, for example, in our case, it's technology called Previdium that is already live with Deutsche Bank and with Gravity and with ADI that we announced yesterday. But once we figure out privacy and we figure out interoperability, it's a big point, so that the user experience is nice, then I think the world will have a lot of these chains. So the metric to look for ZKSync is how much of that we can capture.
Yeah, for us is like, we're a bridge, right? So the main metrics is the total amount of volume that is transferred. So there is the amount of messages that are transferred through the bridge, and then is the volume, basically the amount of money transferred. These are the main metrics, right? Like that is what you want to keep up. And ideally, you want to become the bridge that operates and transfer to all chain for everyone and every protocol. And that like, I think it's just what Interop does, and there's not much more that we can look into, because you could have less user, but if they transfer more volume, it's still good. Like, you just want to have so of course the security is the main aspect, right, for a bridge. So if you have a very in-depth security, and then you become the person, like the protocol that transfer the most volume, then basically you win the game. There's not much else for an Interop protocol to do. Yes, you could monetize your relayers and so on if you want to, but like, that is what you want. You want to be the person in that game that facilitates all of this. So yeah, for us, as long as this goes up, and also I know it's a lot of people are not happy with many chain, but for us, the more chain, the better, because of course that what we do is that we connect chains. So and that's another thing that I find quite important in this cycle, is that it's very hard today with all this new chain, this new L1, all the app chain. Like, it's actually very difficult to predict where the most liquidity is going to be concentrated, right? So, like, something that felt like a bit not obvious, but where you could potentially guess, okay, yeah, most liquidity is going to be on Ethereum for sure. So, like today, like you have Hyperliquid with Hyper EVM, right? Like, who would have thought 2 years ago? And so not only you need to be multi-chain, but you also need to be capable to add a chain, to facilitate that as easily as possible in terms of integration. Because it's something that, interoperability maybe was a good thing to have in the previous cycle, but like in this cycle now, you cannot do anything if you are not capable to be multi-chain. So it's a big difference, and I don't think it is going anywhere else. Like we are pretty confident this is really in our favor, actually.
Yeah, look, we're a privacy chain, so things like TVL need to be rethought, and I think we kind of look at what is the utilization of core utility, set in a more traditional word, product market fit. And are people actually coming and using the core functionality that COTI was developed for? And if so, even if the TVL is actually large, you won't be able to see half to 2/3 of that TVL because we are privacy oriented. So we really care about developer experience, developer sentiment, also our core community sentiment. I think those are kind of like key indicators that if developers are calling you up and saying, I'm really having a hard time implementing X, Y, or Z, then we have a problem. And I think we spend a lot of time thinking about how we work with developers, how we work with community members, and then how we make sure that we're messaging appropriately, making it easy for people on many other chains to come and tap and access our core functionality. So it's really, utilization of core utility and again, product market fit.
So I think we have time for one more question. So let's zoom out just a little bit and look at the traits and that make projects resilient during downturns. Just like general, like high level traits that you would look for. Like if you're just looking across the entire DeFi ecosystem. And then also, what red flags would you be looking for? I mean, obviously, like TVL drop is one of them. I think that's probably the main one. But are there any like canary in the coal mine, like early red flags that you could see, just like that you're generally looking for when you're evaluating projects?
I can give it a shot. So from the foundation, we also invest a lot in our ecosystem. So what do we look for is we try to understand how incentivized the behavior is. So, numbers go up, great, but if you're a long-term investor, you may not care if these numbers are not sustainable. So there is a number go up that makes sense, like Uber incentivizing usage at the beginning, because once you try Uber, you'd never want to touch a taxi ever again. So that's fantastic. But then there is also a number go up that don't make too much sense. Like, for example, in the current perpetual protocol war, Binance has between 0.7 and 1.5 volume over open interest. If you vary very much from this kind of range, and there are some that have like 500 or 1,000 volume over open interest, then there's something strange going on. And then maybe they just figure out something awesome, which in case we want to understand, or that this is not sustainable. So this is what we look for. So, and the metric is different for every project, but there's always something that usually you always have some form of comparison with something that is established. And if you vary very much from the large and established, there should be a reasonable explanation. Otherwise, it's probably not very reliable going forward.
Very nice. I think. Any other thoughts, Pauline?
First you need to have users. We have forgotten that a lot. I feel sometimes you get all this chain sometimes who want to integrate or like those protocols and there's actually no users on it. It seems obvious, but we've seen it so many times that it's worth remembering that. Yeah, if nobody uses your protocol, it's just gonna be tough. It's not sustainable, and like in our case, it's the same for chains. Like, if it's not easy it takes time and money to integrate. Like the network expansion for us is not something that you can do very quickly. So it takes manpower, it takes money. So if your chain cannot prove that there are a lot of users, that you make a lot of transactions, that there's actually a vibrant ecosystem, then it's quite tough for us to legitimate that ask of integrating. So from an interop point of view, it's really what we are looking at. It's like, is anything moving there? Is anything happening at all? Like you can start with not a big TVL, but you need at least to have a lot of transaction happening or like users. That's what I think.
Yeah, building off what Pauline just said, I think it's users, and I think we have to go a step beyond that. Like, in Web 2, we would have looked at something like CAC over LTV, and that would have been like a key metric. And we don't have anything like that in blockchain ecosystems, and we need to get to that direction. Because in blockchain, like there's a game that's played, and I think we're all aware of it, where people offer incentives, they go out and find early builders, but those builders oftentimes are not sticky. So there's users, and then there's a secondary thing that's sticky users. So how long are people coming and actually staying on your chain, building on your chain long term? And how many of those users are quote unquote mercenaries? I think we hear that term thrown around the ecosystem quite a lot. So I think we really have to start getting at some kind of metric that resembles CAC over LTV in the blockchain space to address developers, to address builders, and to address token holders.
Yeah, just kind of get back to the fundamentals and just talk about revenue, really. It's like if you're generating revenue of people paying you for a service, if you can offset your burn rate with cash flow, then you're operating a business. And if that business succeeds because it's generating more revenue than its expenses, then that's great. And I think we should all be aiming for that in crypto and not getting too lost in the source of tokenomics and emissions and whatever else we're trying to build. Like, let's just build the fundamentals and get people on chain using crypto.
Yeah, that makes sense. No need to reinvent the wheel when Web 2's already invented that side of it for us. So I think that's it for time. Really thank you guys, and thank you everyone for being here.
Thank you.
Thank you.
Thank you very much.